So what's ahead for stocks from here? Jefferies chief market strategist David Zervos joins us now. David, want to get your thoughts on all of this as somebody who is such a key Fed watcher and always shares such key insights on this topic and how it intersects with the markets.
Thanks, Morgan. I think you're actually, you guys are kind of all onto the right thing. It's a lot less about are they doing another 25 and more about what's priced into next year and when that happens. I think we're still looking at over 100 basis points cuts in next year, and that's starting kind of mid-year. That's the expectation. Some people obviously are lower, some people are higher, and that's the market expectations coming out mid-year. But I think that's a lot more important than do they go in November, do they go after another bad CPI number or not. And I do think there's a chance we still could get a 0.3 on the next CPI. That's probably enough to tip the scales. But a 0.2 or less, and I think they're standing pat for sure. And I think they're kind of, generally speaking, pretty happy with everything that's going on. That's how I read Jackson Hole. I read Jackson Hole as very much not a victory lap, but just a Fed that's very kind of, happy with how everything has gone, relatively speaking, in the last year, coming off a very difficult year before that, and a lot of inflation fighting that needed to take place, and a lot of, I guess, pain, for lack of a better word. Jay used that a lot at the last Jackson Hole, and this year we didn't hear so much about pain.
Yeah. So in light of that, I want to get your take on the bond market, and what do you think is driving long-term rates higher?
So, Morgan, we talked about this on a few of the programs after the Japanese moves on yield curve control. I do think the Japanese moves on yield curve control did unhinge global long-term yields slightly. I think that was worth at least 10 to 15 basis points on the 10-year, maybe more. I don't think it was expectations on inflation. If you look at break-evens, they haven't really moved much. Five-year break-evens, which is what the Fed looks at, are still right around 2.25. They had a little pop-up. They've come back. So this is really term premium, a little bit of risk premium, and maybe people thinking, there's just not as many buyers out there of the long end if the Japanese are kind of moving a little bit back home in the next few quarters. So I think it's more of that. And I will say more, this is important. I do think that the more the long end kind of stays here above 4% or goes up to 4.25%, it takes a little bit of pressure off the Fed. They don't need to do another 25 if the long end starts working for them. One of the things that's been a little frustrating for them is how inverted the curve was, and it wasn't producing the kind of tightening maybe that they wanted. This is probably helpful in their eyes and takes them into a place where they could be a little bit more complacent with rates or just not have to move them as much aggressively.
Yeah. It's sort of this idea of doing nothing is doing something potentially for the Fed. But so maybe it's helpful for them, but what about investors, especially investors that maybe have gotten to ride or were looking to ride the rally we saw at least through the first half of the year in equities? I mean, is there still a move to the upside there, or do you shift and put more investments to work in something like the bond market or other areas of fixed income right now?
Well, Morgan, at Jefferies, we've been pushing really hard this year on the high-yield bond markets, the loan market, the high-yield bond markets, the structured credit markets. You got a single B, double B portfolio out there that we could, make for any client, yielding 9, 10% very easily. This is not investment grade, but just below investment grade bonds. And I mean, we haven't had yields like this for companies like this in a very long time. We think that's really a sweet spot. That's been a laggard to equities, probably up 7, 8% or around their total return for the year. Still nothing to sneeze at, but certainly on a risk-adjusted basis, I think a much better return than what you've gotten out of equities. And I've been surprised, I think, like many, at how well the equity market has responded to these higher yields. And I think this was I like what happened in the last month. The 4 to 5% correction feels a lot more healthy on a multiple basis and every other basis that I look at risk assets. With these higher risk-free real rates and these higher high-yield bond levels in terms of yields, I just think it's really a hard hill to climb for equities to keep going. So we've been pushing the high-yield bond markets. It's not a risk-off trade. It's not a negative trade, because if we thought there was going to be a big recession or something coming, we wouldn't be pushing high-yield debt. So we don't see it as a recessionary trade. We just see it as a kind of higher for longer. Economy's okay, but the Fed has to do some heavy lifting for a while to make sure that inflation really does get back to that 2% target and sticks it. And that's not something that's going to happen in the next quarter or two. It's going to be a time where we have to kind of, I don't want to say pain, but maybe just a little bit of I don't know, whatever's a little bit less than pain come up with.